Hello everybody, welcome to TraderMerlin Show for your Wednesday edition. Hope you had a great day out there, even though it was a lot of red action, not only in the equity markets, but in the cryptocurrency markets as well. So, yes, Kev, the graphic is still up. The show hasn't started yet. Here it goes. I don't know what day it's June 1st. What I want to do is talk about quantitative tightening because this is a complete shift in what we have been doing. I guess I could ask the question, when was the last time that we had any sort of quantitative tightening? Might be an interesting question for the group here. How far back do you have to go to look at when the Fed actually did quantitative tightening? Of course, you know that 2009 was quantitative easing, QE1, and then we had QE2, and then we had Operation Twist, and we had QE3. So just curious when you guys think was the last time that the Federal Reserve did some form of quantitative tightening. Now, of course, when we look at the sheer numbers out there, it's pretty impressive to look at just from 2020 through today. They've gone from about $3.5 trillion worth of assets to over $9 trillion. So all of a sudden, you got a nice big pop there in the amount of assets on the Fed's balance sheet. At some point, they're going to have to unwind those and put that money back where they, quote unquote, borrowed it from. And that's what we're in the midst of right now, which is why I drew the graphic here. Quantitative tightening with a little bit of a wrench there. And I thought it was a funny comment, which is maybe relatively appropriate from Chase. He says, nice thumbnail. Is that because the Fed is screwing the market? Look, let's be clear. The Fed does not care about the market. At least that's what they say. I call bullshit because you know that the Fed people have investment portfolios, so clearly they do care, but they will say publicly, we don't care about the market, we don't care about the market. They are not supposed to, right? Their main concern is the economy, but of course, if we have a market that goes to hell in a handbasket, that's probably a reflection of the economy. So, in a sense, the Fed does care about the market. So, Kevin's the only one that responded. No, Lori says never. Let's see, Doug Jerving says, heard of quantitative easing, but never quantitative tightening. Yes, QT1. This is QT. Actually, this would be QT2. Margaret says 1988. Well, you know, that's. I love the fact that you guys get to learn things here on a regular basis. So I'm going to jump slides and I'm going to go straight to this chart right here. And I'll share it with you guys. So here is a chart of the Fed's balance sheet. And the answer to the question is really 2017 and 18 was when they started doing quantitative tightening before. Okay? Oh, yes, boss. Boss says that's a bolt, not a screw. Right? You're right. He's right. And you can see that this is the total assets on the balance sheet of the Fed. So you can see that right here in 2017 and 18, they were actually unwinding their balance sheet. So they were reducing their balance sheet. Therefore, you could call that quantitative tightening. But of course, there's all kinds of periods back here. You can see back in 2010, there was a slight one. But this big drop here is actually where they started unwinding their balance sheet and reducing their holdings. Of course, COVID hit. And notice that we actually had an accumulation of assets leading up into 2020. But then it just went absolutely gangbusters, now over $9 trillion. So, I guess the big question for everyone is, well, what does this mean? Well, I wish I had more data on this chart to show you. This is actually from the Federal Reserve, and I'd like to go back even further, but unfortunately, this is all the information I got in the limited time I had to prep for today's show. If we go back historically, I guess what's the question? What's the standard? What's the norm? And you look at this line on the left-hand side of your chart, which goes from, we'll call it 2002 to 2009. It was a very easy, steady increase. I mean, that's about as straight a line as you're going to get. And then all of a sudden, we had the financial crisis. And in 2009, the Fed's balance sheet went from about $1 trillion to about $2.5 trillion in just a few months, right? And I think we could all make the argument that that was probably necessary to help systemic failure of the financial markets. You can put yourself in either camp there. In hindsight, yeah, I personally believe we should have a free market, and the market probably should have tanked on its own, and we would have taken longer to recover. But then again, who wants to see American people suffer? So pump the money into the market and get that market back on its feet. But it just didn't stop. I mean, this was the problem. Like when we did it from 2009 to 10 to 11, by 2011, the markets were trending back up. Things were okay, but they were still aggressively putting the foot to the pedal. And you can see here from 2013 all the way to 2015, it was a real aggressive ramp up. And we went from just under $3 trillion worth of assets to about $4.5 trillion worth of assets in a year. And at the time, that was colossal. I mean, those gains, that amount of asset purchase was just unheard of, unprecedented. And then all of a sudden, we get this one here, which, of course, if you look at the lows pre-COVID, the balance sheet was at about $3.75 trillion. And you fast forward 2 years, and here we are at 8. So they got to put this money back, or at least it's got to get back to some semblance of normality. I think in long term, this trend line should continue. But because of what's happened since 2009, if you look at this chart, I think you can see a lot of experimentation with monetary policy, right? What are they doing, not only monetary, but fiscal policy? How are they manipulating markets? And I think it's one of those, case studies of, I'm going to try all this stuff and see what works and what doesn't. Because ultimately, the people that are going to be left holding the bag and get hurt the most are the retail investors and the small Americans who don't have a lot of money, because the rich people will survive these big drops like this. So, I guess we have to look at what the impacts might be, and I think we've already prepped for this. We've talked about this quite a bit on this program, where as they start to unwind this balance sheet, which right now is going to be about $47.5 trillion, something like that. I think it's $47.5 trillion. Let me rephrase that. $47.5 billion per month of the balance sheet unwind, and then after 3 months, so when we get into September, that number will now double, and it'll be even more aggressive. So I guess we could look at the impacts of quantitative easing and see what that did. Now, unfortunately, I don't have a price chart. It seems to have failed. Well, I don't know if it's failed. It's just, this is like you keep putting fuel on the fire until the fire tells you, hey, don't put any more fuel on me. And that usually means an explosion. Well, I think that our financial markets are, potentially at that explosion point where we could see things really kind of blow up in our face, and the Fed looking at it going, shoot, we shouldn't have put that much money in. By the way, I don't know if anybody saw it. I actually commented on this one and retweeted on my Twitter handle, which is at TraderMerlin. So if you are on Twitter, check that one out. It was Janet Yellen actually saying, I'm sorry, I apologize because I misread inflation. I was like, what? I mean, bravo to her for having the chutzpah to go out and apologize for something so colossal and just admit that they were wrong. Something we generally don't see major politicians do, or Fed chairmen or members of the Federal Reserve actually say, I screwed up. I made a mistake. Sorry for that. My bad. But Janet Yellen actually did that one today, and I thought that was really impressive. Bravo for her for standing up and doing that, because we all knew that it was wrong after the fact, but she made her call. So again, we've talked about this. What's going to happen? They're going to unwind this balance sheet. Again, it's going to be to the tune of about, I believe, $47.5 billion per month, which will be just not that major, right? It takes 20 months to get to $1 trillion. So this is not going to drop very fast. It'll drop similar to what we see here. Back in 2018, a slow, gradual decline unless something chaotic comes up and they have to start pumping money in. But this has gone on a little too aggressive, and that is starting today. So what sort of things are we looking at for them? She should have known better. Well, it's easy for all of us to play Monday morning quarterback after the game is played, to look back and go, God, that was silly, that was stupid. At the time, I'm not trying to defend the Fed. I personally think abolish the Fed, get rid of it. However, the actions of quantitative easing and all the purchases that have been made really did help out the average American. But here's my problem with it. It gave everybody the impression that it was all okay. It gave everyone the impression that, hey, I still have some money and things are looking good and now I have a big portfolio. The smart ones, the ones who will survive the big recessions, the depressions, any sort of market collapse, are the ones that position themselves accordingly for that market failure. Is that you and me? We will position ourselves accordingly. But people who are uneducated about financial markets are going to be left holding the bag. And to me, that's the problem. I feel really bad for those individuals because they just don't know any better. They've been given this illusion that everything was okay, but that's because markets have been pumped with steroids, just juiced. And ultimately, that will come back to bite them. So we'll see how it all pans out, but position ourselves accordingly. And if it does just turn out to be a little blip on the radar and everything goes smooth, great, fine. If it turns out to be a huge, colossal market collapse and we see 50% declines in bond markets and equities and real estate, average American and person around the world is going to be screwed and hurt, but hopefully we will have the wherewithal to position ourselves not only personally, but also to help somebody out around us that we know and love who may be potentially in a precarious position financially. Yep. Yeah, Lori, people are human and make mistakes. Yes, I never make mistakes. Heck, I make mistakes every single day. It's okay to be human. Better say they lied to the people all along, Merlin. Yeah, did they lie? See, they just didn't know. This has been unprecedented. No one's done quantitative easing 1, 2, 3 I guess Japan. You could argue that Japan's been doing it for 20 plus years and hasn't helped their economy. But, either way, we can all critique after the fact. Hopefully during whatever action we made money. Let's see. Well, they are politicians. True. Let's see, Tom, what do you say? The government put us into the Great Recession, with subprime programs. The government put us in this current problem through a number of things ending in money printing. Sure. And I think that's generally the case, right? Generally, we can look at one of two entities that's going to be causing these bubbles. Number one is government, and number two would be the Federal Reserve and their ability to print fiat money. So I think that will never change until we get off fiat currencies, and then we'll still have to contend with, governments that are just. I shake my head at the stupidity of some of those people that are in office, and how dumb they are on some very common issues that the average layman understands. However, they're the ones getting rich off of creating the policies that benefit their portfolio. So, who's the dumb one? Me for not being a politician, or them for taking advantage of everybody? Hey, Frank, good to see you. All right, so let me go through some charts here to see, what the impact of this might be. I'm going to not start with your typical stuff, which is going to be our top 7 markets there. I do actually, before I dive into that, since we are, recapping what happened in the month of May, the month is over, let me real quickly, I want to run through a few things here, and I like doing this. I know for some of you it's probably boring and you know these numbers, but I want to run through the 7 markets that we look at, not only for what it did for the month, but I'm going to start doing something different, which is what was the trading range for the month, just to give you an idea of how epic, absolutely epic, the month of May was. So let's start things off at the bottom, work our way up. Of course, the big loser for the month, everybody knows that, was Bitcoin. Still sucked. Today was another big down day as well. Down 17.56% for the month. And it's one of those monthly charts that you're like, God, I hope I'm not long. And here I am holding long positions. But here is the monthly chart of Bitcoin. Let me just give you that one. Here is your monthly, so you guys can see what's gone on with Bitcoin over the past few months. And just to look, 1, 2, 3, 4, 5, 6, just the past 7 months from peak to trough, you're down 63%. Well, we were down 17.56 for the month of May. You can see that was a pretty ugly one there. We'll look at those charts here a little more in depth as we progress. Moving on up that ladder, NASDAQ was down. Ooh, it should be red. I just didn't color code it because I was rushing to get the show ready today. NASDAQ for the month of May was actually negative 1.56%. It should be colored red. Apologize for the green, but it is negative 1.56. Let's continue on here to the Russell, which is actually positive 0.03%. S&P was up 0.13%. Dow was up 0.32. We got 2 more. Oil up 4.43. And then the big winner was gold, 10.1%. So a nice showing for gold for the month. Found that would be happy, especially hoping silver starts to recoup some of its losses as well. As you guys know, I have a big position in silver. But while those numbers aren't overly exciting, except for the Bitcoin and the gold. I mean, you got double-digit returns there. Look what they did for the month of May. I'm going from the low point to its high point, right? Taking the range of candle and going from low to high. Bitcoin moved 58%. NASDAQ was up, had a almost 18% range. Russell was 15% range. S&P 13%. Dow was 11%. Oil 22% range, and gold 7%. So for people like unfortunately, I don't day trade as much as I used to, but for people like Jerry Baldwin and Brandon Wendell, who are more active and out there on a regular basis making trades, the month of May is the stuff that you look for. This is like whole hallelujah, play the spiritual music right now. Amazing trading opportunities, whether you're long-term or short-term, right? At the end of the month, some of the people who were holding the Dow and S&P and Russell were like, meh, nothing happened. But it moved 20%, these huge swings. So just awesome moves. I wanted to share that with everybody because I like looking at the end of the month what it looks like. There is that mantra that says, sell in May and go away. And I did add or opened up some puts because I was out of everything, but opened up some puts. Unfortunately, I was hoping for a bigger bear market rally so I could add some more to my position, but I did not, and we'll see. I still am in the camp thinking we might move up a little bit more on a bear rally, but doesn't feel that way after the last 2 sessions. You see gold down 3.2%. Let me go here, and I'll just show you where I pull these numbers from. Let's go to gold. Here's GC. And that is monthly. You're all right, Michael. How the hell did I get that number? Let's see, G. Very interesting. I've got 7. Oh, you know what? You're right. I will show you. It's you know what it is? The 10.01, that is the, wow, my numbers are all screwed up now. Are you kidding me? 10.01 is for oil, but for some reason, I got them backwards. Damn it, I did all this work, and I got my numbers wrong. Thanks, Mike, for catching that. I wrote them down manually yesterday, and I was trying to put them in before the show today, so I screwed up. Damn it. See? We talk about making mistakes all the time, and here I make one on the show, and Mike catches me on that one. So I will fix that for you guys. Gold at its maximum swing was 7.04, but it actually was negative. I don't know why I didn't catch that. 3.74. There you go. That's what the number. Oh, come on, Merlin. That's what your number is right there. Not sure why that happened. Now I'm second guessing all my numbers. Thanks, Mike. I do appreciate you actually catching me on that one. I normally don't make mistakes like that. Let me make sure I got everything right. Yeah, no, my numbers are off. These are wrong. I'm not putting the camera on myself because I'm having like a hot flash because I hate being wrong. And it actually was here. The big gainer was oil. There you go. So big gainer was oil. It was up 10.1%. That was, I don't know why I had those backwards, but apologize for that. I made mistake. Mongo make mistake. Okay. Well, I will move on from that, and let's look at what happened out there today, just because there's your updated and corrected list. Sorry about that. All right, let me just run through our top 7 markets here, and I also want to look at the impact from this quantitative tightening, which is exciting. Let's start things off with the dollar index. So there's your monthly, but I want to look at the daily because we have had a surge over the past couple of days. Remember, if the Fed is selling bonds and retiring that money. So if they sell $40 billion a month, they're taking that $40 billion and removing it from money supply. So what that means, what that means is money supply is becoming thinner. There's less dollars in circulation. Now, it's not a colossal decline in the number of dollars, but it's going to start to have an impact. And therefore, I think you're going to start to see this dollar rally back up and challenge those highs we see back here about 105. Looking at the bond markets, which of course should have a big impact here because they're going to start pushing these bonds out in the marketplace. Here you've seen the yield rallying over the past few days. Why? Because the Fed is officially starting to sell those bonds in the marketplaces. So we're going to start to see this one head up. And I think that this will be a bit more of a push to the upside with the 10-year. Now, as this starts to move up, I do think that that's going to have a bigger impact on housing and real estate and new home sales. So we'll keep an eye on that. I won't be concerned until we get up to, let's say, 3.15%. Once we get back up to there and we have to break those highs, then we'll be off to the races. But it's almost forming a head and shoulders pattern right now. Almost. You had the similar picture with the 30-year. The 30-year just doesn't appear to have the same head and shoulders formation, but it's showing a little bit of strength here. And then let's see what else was of interest today. I won't run through the crypto because that was just a bloodbath. But really the dollar, we could look at most of the dollar-denominated currencies like USD CAD. Right, that dollar has been falling aggressively against the Canadian dollar, but all of a sudden it held today. And there were a lot of patterns that formed. I got to give Skilled Stocksman, which I think he's probably here today. Skilled Stocksman was making a comment and says, does the monthly chart of the S&P 500 represent indecision? And it really does. So I will take out this last candle. I'll just look at it from there. All right. When you have something like this, I'll get rid of the yellow box. We'll leave our lines on there. When you have the candle like this, where it open and close right around the same price, it's considered a doji, right? So doji is where the open and close is pretty much the same. What you had here is a little bit different because normally indecision, you get a small topping tail and bottoming tail. This is obviously not that. This is a massive topping and bottoming tail here on the S&P 500 for the monthly. What that means is not only was there indecision, but there's a tremendous amount of emotion, right? And we could look at the ES, add on volume, and you can see it was higher than normal volume. Even when, for the month of April, when we had just nothing but down, it was just a bloodbath for the entire month and closing near the lows, volume still wasn't that high. That tells me personally that things are probably going to continue. When you have a really high spike of volume, that usually means capitulation and things start to turn. I say usually, it doesn't always work that way. But notice this is one of the highest monthly readings on volume we've had since last March. So May's volume is the highest level of volume we've had going back 13, 14 months. and it was on that period where this thing was just declining aggressively. So it pushed right back up. I guess the question is, what happens in this situation from here? What normally would happen in a situation like this is you actually get, I hate to say it, a rip to the upside. Why? Well, look, notice the long bottoming tail, right? That means at some point this was one gigantic red candle, right? I'm looking at the one on the hard red edge. At some point that was a gigantic red candle. And the buyers came back in and pushed that thing up, and it closed it right where it opened. Now, granted, it was up at one point, but the bottoming tail kind of tells you who was in control. To end it, the buyers were in control. They pushed it all the way back up. Now, we could make that same argument for everybody looking at candles and trying to analyze price charts here. If you look at the candles that formed for January, I'm on a monthly, right, by the way, of the S&P. January, February, and March. Notice those all look similar to the candle we formed for May. You have a small topping tail, long bottoming tails, and in the case of those ones, for January, February, and March, they actually had a fairly large defined real body. So even with those candles, I would say I had more of a bullish bias, but look what happened. We just kept drifting down. So I'm just going off of probability and kind of historically, what does this candle mean, and how does that price reflect on my opinions about where the market's going to go going forward. Right now, it looks bullish. However, how did we end the month? Right? We were trying, let's bring out that daily. We were trying at the end of the month, there was this nice rush up, aggressively moved up, and recouped a lot of the losses. So how did we end it? We ended with the buyers in control. I will take out today's trading. That is, let me put a yellow box around it for everybody here, just so you can all see exactly what the month was. I know you can probably read it, but here's your month. Inside this yellow box is the full month of May's trading. Okay? And you can see that we started strong and then fell apart. But who closed it? Who finished strong? To me, it was the buyers. So that's when I mentioned that I'm anticipating a little bit more buying movement. That's simply because of what happened in the month. I feel like there was a strong surge. You could call that window dressing, or saying people were doing stuff to their positions to try to get, sell the bad stuff, jump on the winners, and push things higher. Who knows? I don't know where market's going to go. Obviously, today's action doesn't start the month of June off very well. We'll have to wait and see. Plus, you have that overhead looming, quantitative tightening piece that I think will probably have a long-term negative impact on the markets. Plus, you're seeing some earnings come out that are pretty bad. So, for example, here's your earnings that happened today. I'll look at just some of the more popular ones. Here's GameStop, which missed earnings by 50%. They were supposed to lose $1.37. Wow, surprise! They lost even more than expected, down 1.5%. Cons, which is an electronics store, horrible name for an electronics store, by the way. They had a miss on their price, though, right? So they beat earnings by 38%, and we're still down 5%. Most of these, you notice today, even though they beat, Sentinel One beat pretty handily, and they were down 7% on the day. You had Hewlett Packard, they actually missed, and they were down 6%, but most missed and sold off from there. That's your earnings. Your economic calendar showed me a couple of things that are interesting as well. You remember I talked yesterday about the construction spending and saying, look, if things are slowing down in the pending home sales market, which we saw a significant decline in pending home sales, also in new home sales, that could reflect into construction spending declining. And they were actually expecting it to go from 0.3 to 0.7. And I was like, I don't see that happening, but good. We came out at 0.2, which means that there's a lot less spending on construction, maybe because a lot of people feeling like now is the time to not sell their homes. You may have missed that boat, so why bother doing construction spending on your home if you're not going to sell it into that rich market that was going on for several years? So that was a pretty ugly number for me. However, it's not all ugly, by the way. If you look at the manufacturing prices, this is a little bit ugly because it did increase over expectations, but manufacturing prices did drop a little bit over the previous. That's good. Great news here. You have tons and tons of job openings. Now, they were expected to drop from 11.86 million jobs to 11.2, so a decline of 500,000 jobs. It only declined to 11.4. So there's still plenty and plenty and plenty of jobs out there. Now, just curious what you guys think about the Elon Musk thing. I don't know if anybody saw what Elon Musk tweeted out today or emailed all of his employees. I'm sure that I will polarize part of my audience on this one. And if you don't know what he said, I'll paraphrase. And he basically said, look, if you want to work remotely for Tesla, you can do so outside of your normal 40 plus hours that you will be working at the factory. I want you physically in the building. If you don't show up and work at least 40 hours a week at the building for your physical location, then we will consider that job abandonment and you will be terminated. So if you want to work, show up to the office and work 40 hours a week. Now, I know that some of you are like, great. Some of you thinking this is horrible, and shame on those people. Having gone through, and we've all experienced COVID personally. There's no one here that didn't experience COVID. And most of us had the misfortune of being forced to leave the physical workplace, go work from home. There are some people who are great at working remote. My good friend Kerry, he is probably one of the best remote workers I've ever seen in my life, and I would trust him. I don't care what he says he's going to go. He says he's going to Europe for 7 months straight, but he'll get his job done. This guy is epic. I trust him implicitly. However, that said, I work with a lot of people who I feel have been absolutely abusing this. That they were sitting from home. I won't mention anybody's name, but I had a colleague who was posting pictures of himself and his wife sitting in a hot tub on a Wednesday afternoon when they were supposed to actually be on a conference call drinking margaritas. And I'm like, first of all, you're an idiot for posting this stuff with you and your wife in a hot tub on a Wednesday afternoon when you're supposed to be working. Like, how stupid can you be? However, there's no repercussion because nobody cared. I was the only one that took offense to it. Some people, like Lisa here, can probably do very good at working remotely. Others, I think, are abusing it to no end. Just going out and going shopping all day and, just making sure that your phone's on standby or keeping your an app open on your computer so it looks like you're actually at your computer the whole time. That's another trick a lot of people are doing, and they're just leaving and don't care. To me, I love it. I'm sorry, I am totally in Elon Musk's camp. I think that the productivity where I personally work would increase dramatically, and the efficiency, the synergies between the employees, the communication would increase dramatically. So I actually love it, but he is getting so much heat for this. I'm with you, Big Eb. It's so easy. Would you rather spend 20 minutes writing an email to somebody that lives that works down the hall from you, or just get up from your chair, walk in? Hey, Kevin, I got a quick question. What about this and this? All right? Okay, great. Excellent. And what about that and that? Great. I've now eliminated the need for senseless emails and a waste of time, and I've expedited communication process. Anyway, I'm going off on this one because I wish everybody at OTA was back physically in that building because I felt like we got so much more done. And we're still getting an amazing amount done, but I also miss seeing the people and the camaraderie and all that stuff. So, I don't know. I'm sure people have mixed feelings about it, but some people can work great remotely. I can work great remotely, but I go to the office almost every single day. You do not create morale in a company being remote. True. And you have all the Zoom meetings you want. It's like, oh, yay, let's talk to Thomas. What'd you do today, Thomas? I went fishing with my family last week. I don't know. I guess I'm old-fashioned. I personally like to see the physical. I think that, and I'm not so concerned about people working remote. It's just the efficiency. I'm seeing a lack of productivity across the board. So bravo, Elon, for posting that. OG, I miss seeing girls at work. OG, I'm going to need you to talk to the HR department real quick about some compliance issues. Anyway, sorry, my rant is over. I apologize for that. I agree with Chase. I think that if the employee can prove that they are efficient working remotely, great. But I think that there's a lack of oversight, a lack of monitoring of specific employees. And boy, I can tell you, I know a lot of people who have really abused that system. So I'm going to ask this question here real quick, just because I know we've got Lori and Lisa here. As you guys know, Friday a week or so ago, I did a little session for them in their easy options. And Gary says, can you ask Lisa or Lori at OTA to post recordings from my May 20th session? If they do that, and I'm not sure, Lisa, Lori, you can probably answer that in chat with regards to are those sessions recorded and posted? If they do, it will be behind the clubhouse wall, so you'd have to be a mastermind member to get into that one regardless. So I know a lot of people here may not be able to get in there because you probably aren't mastermind students at OTA. Let's see, what else do I have here? We went off on all kinds of crazy topics today. Dawn asked this question, and I'll keep it really simple. A Oh, so they only keep recordings for 7 days. So that session is gone, apparently. So sorry. Sorry, Gary. Don says, I'd be interested to know your thoughts on the best 2 to 3 journaling software out there from your experience. I've never used a journaling software, and honestly, I couldn't even tell you what they are, so I apologize for that. I always use little spiral notebooks, so I go to Target and buy some spiral notebooks, and those are my journaling books. Does anybody in here use a journaling software? And if so, do you like it? Would you recommend it? And what's the name? Just go ahead and type it in chat, and hopefully Don's listening or watching right now. But, I've made this point time and time again on how critical, especially during your beginning years, like your first few years, you should be documenting and journaling as much as you can just to help further immerse you in that world and say, here's all the things I'm looking at. Here's what happened in the market today. I think it's critical to be journaling. Also, Dr. Woody Johnson, who's been on this program before, he made a very clear point that for him, it's great to be journaling not only from your analytics side, meaning how's your trade going, what are the rules, entry, stop, price, target, all that stuff, indicators, but what are you personally feeling? What's going through your mind emotionally as you do it? And I think that really helps as well. So yeah, I'm with Thomas, and I'm old school, pen and paper for Gallo, notebooks, sure. Rob uses one called Edgework. Okay. All I use is Google Sheets, Tom Barr. Okay. It's unfortunate I didn't keep mine either, because mine that I started out with, I just kind of threw them away over the years. Like, I'm just cleaning stuff out. I don't need the ones from the late 90s anymore, but I kind of wish I would have kept them so I could share those and show kind of the progression of how you document and what it looks like, but they'd be binders. Frank says composite notebooks. You can use something as simple as this little guy, right? Let's see, I'll make sure I get a clean page here. As you can see, I take lots of notes, but, just a simple page like that. And, each day on the top of it, write the day. And here's the date. Here's the trades. What I actually really enjoy doing in mine is I just took, my charts used to all be white with black and white candles. So it was easy for me to print charts. So I would print pictures of the chart. So let's say, for example, I'd have this chart right here. Let's see, which one am I interested in? Let's look at Ethereum real quick, just because that was a fun one today. If you look at the Ethereum chart, I would print this one out looking like this, right? So I would print this chart out right here. Of course, I wouldn't need all this extra stuff, so I would just take a screenshot of just the chart. And I think actually in TradingView, there's a button you can hit that takes the chart and sends it out right here. Take a snapshot. So if you click on that, it'll say Save Chart Image. So easy now. And since it's all white, it doesn't rip your toner apart. So I would add these to my trade plan and say, all right, looking at Ethereum, right? I'm thinking of going long at 1733. Why? Well, because we've had a touchback here on May 24th or May 23rd. We also hit the same spot on June 23rd, June 26th. We go forward into July 21st. We hit it again this year on May 12th and multiple times. So I'm using that as a floor, and I start to add on the reasons why I like to buy there. Now, one thing I would also do and encourage you here is an example like that, what I would create on my trade journal if I was planning on taking the trade is, I've shown you this many times, I just put a plus and a minus, and I try to be as objective as possible, and I encourage a lot of you to practice this. Pick any chart, right? Pick any chart you want, just randomly pick a symbol and say, okay, it's a daily time frame. Fine, I'll pick Apple. Let's just do it. All right, I'm gonna do the exercise for you right now just so you guys can see kind of what helped me early on in being objective and not emotional about making trades. Actually, I'll let you guys pick. Whoever gets the first symbol in, I will do this analysis. So whoever gets the first ticker symbol in, I will do the analysis, as I mentioned, and show you what this exercise is all about and why you should do it. So I'll wait for the first ticker symbol to come through. Probably gonna take about 30 seconds to get into the delay here. Do you see it going back to 1700? Frank, I see it going to 1700. It's a question of does it break it? Tom won. Sorry, Lori. Tom beat you. He got Microsoft in there. So let's go MSFT, right? There's Microsoft. So what I would do, it's a very simple exercise, guys. I would simply take a piece of paper and do a plus and a minus. Plus means all the reasons that you should go long. Minus means all the reasons you think you should go short. So let's just talk about going long on Microsoft. So why would I want to go long on Microsoft? Well, we could argue that this has been an extreme uptrend for a very long period of time, and this is a pullback, right? So I guess you'd have to calculate out from where you want to draw your analysis from. Let's just do a fib retracement from the lows we saw back in 2020 to where we are today. and we could make the assessment that, look, we came down, we did pretty much a 38% retracement, maybe a little more, and now we're starting to see a bounce off of that. So I'm expecting, in the plus column, I would say this is a retracement in the greater trend, right? So I'm looking for a pullback, and I might look at some things like the longer term period moving averages. So let me see if I can change this to a 200. Nope, not what I wanted there. Okay, let's make that a 200 period moving average. And, ooh, all right. So I'm trying to find support for me going long on Microsoft. And I could add on all kinds of indicators. Right now, we could say I'm going to make the assumption that on the daily, it ripped down below its oversold period, and now it's bouncing back in. So let me add in a couple indicators here just for fun. If you guys have some indicators you want me to look at, it's always nice to add in different indicators, but let's just go to Bollinger Bands. All right, so here's Bollinger Bands. As you'll notice, it ripped out below the lower Bollinger Band. All right, so you can see right here, we pierced that lower Bollinger Band, so I could argue that we came down to a 38% retracement on fibs. That's in the plus column. We exceeded the lower Bollinger Bands on an aggressive down move. That's also going to be in the positive column. I can take that one out of there, and let's just look at stochastics. I won't do a whole bunch of these, and we'll go to stochastics. All right, you'll notice a lot of the support, the factors I'm going to be looking at here are going to be technical. So let's just go here, hard red edge, so you can see what happened. We were in an oversold situation, and now all of a sudden we crossed above that 20 line, and we're ripping to the upside, so I've got another piece buying here. Les wants to look at RSI. Great. Let's go look at RSI. RSI is going to tell you pretty much the same thing. Oops. Go to indicators, RSI, and there it is. So it actually wasn't an oversold situation, right? You'll notice here that you had, for RSI, when you get down below 30, that's oversold. When it's above 70, that's overbought. We were just kind of traversing. So this isn't really a bullish or bearish thing. Right now that you see RSI above 50 and trending upwards, that's a bullish piece, so we could make the argument that should be in the plus column as well. So those are some of the plus pieces. A pullback in the bigger trend. It's pulled back into a Fibonacci number. It's outside the lower Bollinger Bands. It was outside the RSI and outside stochastics, and trending up on RSI. So that's the argument there. Now I flip this whole thing, and what I would actually continue to do is say, what are the things that are negative to going long, right? So what would be bad for me going long? Well, you notice here I've got a 200 period moving average, which is rolling over and pointing down, which is bad. But we can make that argument about all sorts of other moving averages as well. So let me just change this to a more common one, like the 20 period moving average, and you'll see that it's going to have a hook to it, but it's still trending down, right? It's just starting to curl. So all the moving averages are telling us to go short. So if I'm thinking about going long, these are conflicting signals, and I have to make the assessment as to, is it worth it for me to go against these indicators? I don't know. That's a decision you got to make. So I would do this whole process about me going long on Microsoft, and then I have two columns, and here's all the things that would support me going long Microsoft, and here's a bunch of things that would contradict and say, no, don't go long Microsoft. And then ultimately I have to go and see, is the risk reward worth it, and then see if I really want to make that trade. What I found in doing that exercise, especially if you're just doing it very objectively, not being biased and saying, I know I got to go long. Don't do that. Say, what if I go long? And then flip the whole discussion, look at that price chart again, and say, what if I go short? What are the things that are supporting me to go short here? And now all of a sudden I can maybe dissuade myself or talk myself out of a bad trade simply by my analysis. So if I say, what are all the reasons to support me going short? Moving averages. All these moving averages are pointing to the south side. It looks like it's now in a downtrend because it's making lower lows and lower highs. We could take a step back and look at some of the macroeconomic pieces, right? You got the Fed, quantitative tightening. You've got bond markets starting to rise. A lot of pressure on the equity markets. Maybe a shift out of technology. So I might find some arguments that make me want to go short on this one. But too many people get emotional. They jump on the Jim Cramer bandwagon or some other celebrity or some influencer out there and say, oh, I got to follow what they do. No, you're going to make your own decision. And if you do it the way I just presented with a piece of paper and journaling, you can really save yourself a lot of grief, a lot of trades that you probably shouldn't be in anyway, and just, I guess, gives you a lot more peace of mind knowing that you're well aware of what's going on with that specific security. So that's one of the exercises I used to do a lot. Now I just do it in my head. You'll find that the more you do this, the more it just becomes a pattern. How many things do you look at now? Well, Margaret, good question. Are you referencing how many different securities I'm looking at or how many indicators and factors? If it's securities, I don't have a limit. I really don't. I have a typical watch list. I guess it depends on portfolio. As you notice here, when I do my 1% strategy, I really only look at these guys here. I've got 10 or 12 different ETFs. I would say there's no more than 15 investments that I would look at. But as far as limiting myself from saying, I can't trade lumber or soybeans or wheat or cryptocurrencies or dollar index, I can trade everything. Now, I certainly like to whittle it down a little bit because I don't want to overwhelm myself. Now, you said what factors? So one of the things I found that hurt me is, okay, I'll give you an example. This is actually a pretty funny one from a class I taught back in 2007 or 8 at Online Trading Academy in Irvine. And there was this guy in class, and he was in FAS, I think. Yes, so this was triple bullish financials. And the chart looked awful at the time, right? It looked really bad. So I said, as part of being an instructor, I like to show whatever you guys want to look at, right? So I said, hey, anybody got something they want to look at? And he goes, what about FAS? So I bring up FAS, and I was like, man, this looks really bad. You've got a downtrend going here. I got all the moving averages are pointing to the south side. You're in a triple leveraged long position, and it's going down against you. I mean, and I had a whole list of arguments. And so he was kind of quiet about it and asked a couple other people in the room, and they're like, no, we agree. Go short this one, right? Okay. Well, on the break, this guy got up, and he was going around from person to person asking, hey, what do you think of FAS? I bought it for this and this, and look at this, and look at this, and look at this. And ultimately what ended up happening is he had out of, let's say, 30 students, 25 of them were going, go short. This thing looks bad. And just at 2 or 3, I think we're just trying to be sympathetic and going, oh, yeah, I could see why you bought that one. Yeah, that makes sense. And he's like, see, I told you. The old phrase is, if you torture a chart long enough, it'll tell you anything you want to hear. So to Margaret's point about factors, I like to look at all of them, but you have to know the specific strengths and weaknesses of each one, right? I got to know the strengths and weaknesses of stochastics and RSI, and what are the weak points, right? When does this not work? And when is it more likely to work? And how to use it. I'm actually building a series right now for Online Trading Academy, kind of on technical indicators. So I'm hoping I can start recording those here soon. I've just been pretty damn busy. We'll be looking at things like stochastics and Bollingers and MACD and RSI, as well as some chart patterns, and really, what are the misconceptions about them and how do you use them more appropriately. So, Margaret, I don't have a limit on the number of factors. One area I think I have a distinct advantage over most is I've looked at so many charts. I mean, I wish I could have kept track. It's got to be in the tens of millions of charts I've looked at over my career. And, do I need to look at this price chart to tell me what the moving averages are? A lot of people do, right? We'll see that if I put the 20, it's going to be aggressively up over here. It's going to be flattening. And then all of a sudden you've got an aggressive down and it's just starting to change its angle. How do I know? Because I've seen this many times. So I can look at price action and know fairly close. I'm not going to be exact, but I could probably draw this line on here with fairly good accuracy. Do I need to put it on stochastics or Bollinger Bands? I don't need to do that either, right? It's my brain now sees what the charts are telling me. So that's just experience. And I think the more you do it, the more you look at it, the more you test yourself, the better it's going to be. It's kind of like saying, when you're a kid and you started riding a bike, did you have your balance the first time? No. But the more you ride it, pretty soon you don't need those training wheels anymore. And all of a sudden you can ride the bike with no hands. Don't recommend that after a couple of beers, but you could still be doing that. So most of you are probably in that phase right now where you're still discovering, you're still building, you're still learning. Put the indicators, I would say pick any chart. It's a great exercise. I loved it. Pick an indicator that you want to learn more about, right? So let's just go back to, I think I can hide this one. There we go. So I've got RSI down here at the bottom, and I've got 20-period moving average. So, you pick anything. Pick Tesla. And as an exercise to you, look at the price chart of Tesla and say, okay, what do I think that 20-period moving average is going to be doing? It's going to probably have cut right through here, right? I wish I could draw on the screen for you. But it'll cut right through here. It's going to be pointing down and just starting to curl up. How do we know? Well, because these 4 candles are ripping back up. So you draw it in your head, and then you turn it on and see how close you were. Well, So I was slightly wrong. It actually hasn't even bumped up here, which is kind of surprising. The 20 period, this should have a curl at the end, but I guess because it was so aggressively down, we don't have the curl yet. You look at, and then you ask yourself, well, what would it be saying with the RSI? Well, RSI, it's probably going to be back getting close to that 50 mark. My guess is it's going to have a pretty big move up. And we can go here and show that one. Uh-oh. Oh, there it is. There it is. And there you go. You're back towards the 50 line. So, it's just testing yourself. It's like doing little quizzes on every single chart. Just turn them on and off. Start with no indicators and then add them if you want to learn what they look like. And then eventually you can take a real quick glance at any price chart and have a pretty good idea of what all of these technical indicators I'll tell you. I keep playing with the various tech indicators, but I keep coming back to just the charts. Yep. Absolutely, Doug. I mean, come on. Most of you are fairly regulars on this show. My charts usually look like this, don't they? You usually don't see me with lines. I mean, all I do is draw horizontal lines or trend lines, and those ones I keep on my chart. Indicators I don't need anymore. You start to get too many indicators on here, and I know a lot of people that their charts start to look just like a complete mess, right? There's RSI, and then they'll add some more on top here, and next thing you know, you forget what price is. That's a bad way of doing it. All right, I didn't realize we're like running late here. Crikey. Let's look at what's going on for tomorrow so I can wrap up here. Get ready for my session in the crypto program tonight, which I might see some of you guys in there. Here's your earnings calendar for tomorrow. You got Lululemon, you got RH, which is fairly small, OKTA, Okta, Sienna, and then Hormel Foods. I thought Hormel Foods would actually be a pretty good one for tomorrow, given the fact that we hear so much about inflation. Are they making some good money on this one? So that's reporting earnings. They're all reporting earnings tomorrow. And then here's your economic announcements. I will take my little red drawing pen over here to show you kind of the important stuff. The one that most people are watching is this guy, ADP, non-farm employment change. They're expecting a lot of new jobs to be created, significant increase. My guess is it will come out. I'm going to just write this down here. I'm going to say 265. I think you're going to increase, but I don't think it's going to be as much as expectations, which would further put a little bit of negativity on the market. You have unemployment claims coming out tomorrow. You got natural gas storage. You got crude oil inventories. FOMC member Mester will be speaking. So a lot of big stuff happening for the U.S., and if you're trading the euro, you've got the German trade balance and some French industrial production numbers coming out tomorrow, as well as some bond auctions over in Europe. All right, what did Chase say here? Chase says, do you use fixed range volume profile at all? Seems to map out good levels, including, I don't know. I don't. Again, the stuff I'm using is what everybody's looking at, right? So when you start to use range volume candles, you're eliminating a bulk of the actual traders. I think you're eliminating the people that are looking at price charts. You're looking at specifically some fundamental data within the price chart, if that makes sense. You're not really looking at the price chart itself anymore. You're saying extrapolate the data from that price chart and give me a reading as to what you think may have happened. And that's just me personally. I like to look at the price charts and say, I can see what's happening here. I know what's going on because I can see what everybody else is looking at. I mean, that's how supply and demand works, right? Supply and demand is saying, how do these levels form? What do the candles look like when it enters a zone or leaves a zone? How can I anticipate where those institutions are, the footprints from institutions? Like today, if you look at crude oil over the last couple of days, crude oil looks like it's headed for a pullback, right? We talked about the breakout. Got the rip to the upside here. It broke through. Looked like we're at 120 yesterday, and then came screaming back down and looked like it'd be a great short today. Didn't come through. So, for me, I'm looking at the low of today on crude oil, which was the low for today was 114.58. If we get below 114.58 tomorrow, we're going to open up here, but if we could down below there, it could be a great shorting opportunity. Even though it's going counter trend, the sellers here on high volume broke it through that overhead supply and ripped it back down. You won't see that if you're using fixed range volume profile. So, just my 2 cents. I think it's funny that Hormel ticker is... That's pretty good. Hurl. Yeah, well, I'm not a big fan of canned meat products anyway. Michael says, I love ADP. Worked for ADP for 25. Wow. I was involved in the new hire government data. Well, Michael, you can give us the inside scoop. All right, that's going to do it for me for today, everybody. Yeah, I don't have any guests. I'm going to work on... A friend of mine recommended somebody to talk about collectibles, which I think might be an interesting topic. So I'll reach out and see if I can get this gentleman on the program. He comes highly recommended in the collectible, sports memorabilia stuff, not necessarily coins, but baseball cards and there's huge money in that stuff. Crazy. So maybe I'll bring that on as a different idea of alternative investment, something to think about. If you guys have some topic you want me to cover or just want to comment, you can click on the YouTube video or down below the YouTube video, type in your question there, as I know that most of you are already subscribed. If you're not, hit that subscribe button, and that will probably help out this channel as well. If not, you can email me at TraderMerlin@gmail.com. Till then, happy trading, everybody. I will see you for your Thursday session. I'm hoping I have Thursday session because I do believe I have. I'll be teaching at UCI tomorrow with Larry, so I may not. I'm 99% sure I'll be doing the show tomorrow, but if not, I will tweet out that I can't. But I'm pretty sure I'll be able to do a show tomorrow. That said, have a fantastic one. I will hopefully see you guys tomorrow. Take care.